Friday, the 28th of December. Welcome to Business Morning. I am Boason, Omofayo. We're live to you from Lagos, the headquarters of Channels Television, Nigeria's news leader. Let's get the show started. What came in overnight? Fitch Ratings says Nigeria's 2020 economic outlook have been cut to negative with a B+ affirmation on the back of increasing vulnerability in the current macro policy setting and rising risks of disruptive macroeconomic adjustment in the medium term as we continue to see real appreciation of the Naira, beg your pardon. According to Fitch, a sharp devaluation of the exchange rate under the current policy framework would cause macroeconomic volatility and significantly weaken some of the country's key credit metrics, including GDP per capita in US dollar terms and the share of Nigeria's GDP among the rest of the world. Meantime, the rating agency forecasts that the Nigerian government deficit will dip into 4.4% of the GDP in 2019 and stabilize next year, while inflation will rise to an average of 13% within the 2020-2021 period, an average GDP growth rate of 2.4% for 2019-2021 period. A similar revision of the country's economic outlook to negative from stable was announced by Moody's Investor Services on December the 5th. All eyes now on Standard & Poor's, the third of the three largest rating agencies in the world, to give its outlook on Nigeria. But let's talk about Nigeria's debt market in 2019. The bad news is nothing lasts forever. The good news is nothing lasts forever as well. So let's drill down the debt market in 2019 with this technical analysis with Ayodeji, who is an investment banker and chief executive officer at Afrinvest Securities. Ayodeji is joining us live here at our global headquarters here in Lagos. Ayodeji, good morning.
Good morning.
One of the most interesting markets of our market segments for this year is the debt market. 2016, it was currency market, all the Naira, but now we're down to the debt market. It's been an interesting year, but if you look at what I just talked about, I just found out this morning that the bad news is that nothing lasts forever. The good news is also that nothing lasts forever. Is that the scenario we now have on our hands?
Yes, interesting.
That's a picture quote there from J. Cole, by the way. That was the bad news, and what's the good news now in the debt market?
Yeah, interestingly, if you look at the trend, looking as far back as 2006, you look at in 2010, we had yield go as low as 1.9%, even for 1 year bill. And we also saw that sharp decline in 2016. In 2010, it was after the banking crisis, and the CBN was trying to boost liquidity in the system with the anticipation that that banks will lend. Also in 2016, that was also the scenario. But what we've seen this year is a lot of policies has been released per time, and that has shaped in terms of the direction and the direction of yield we've seen in 2019. If you recall, if you look at in terms of the first quarter, immediately after the election, yields were still high at an average of about 14%. And because immediately after that election, we saw foreign investors come in significantly, and that drove yields slightly downwards. You looking at the capital importation report by the MBS, about $5.9 billion came into money market short-term investments, and that has continued to decline to about $3 billion in Q2, about $1 billion in Q3. We've seen that the trend as a result of the policy, the CBN, based on its own policy, discovered that a lot of even the local investors, even the banks, were just sitting and borrowing and putting funds in the fixed income market, enjoying that high
lending
yield.
money to the government and just sitting back and see their money work for them as it were.
Yield.
But I want to put this a chart on the screen for our viewers to see, which is the fixed income market. That's what you folks call it so far this year. And this yield curve looks like that's what is on the screen right now. Ayodeji, I'm sure you're looking at that. It looks a little bit like putting a spaghetti in hot water.
Yes. So, yeah, starting from a high of close to 15%. Even if you look at the first primary market auction for this year, in January, the first primary market auction yield was around 14.5%. That's in terms of discount rates. And the last one that held just on Wednesday, the discount rate was around 5.9%. You can see that massive drop. We've seen that with the policies, when you let's review looking at some of those policies.
Yes, that's why I want the chart back on the screen.
Those
quickly to explain, because if you look at where we're coming from, as at the end of December last year, about the same time last year, and that is the green line there. That's what we're trying to explain, the downward trend in the yields despite the election. So we had the elections, yes, but do you think that was not a major disincentive?
Yes, CBN was very deliberate in terms of trying to see how investors, banks can begin to look at other investment options. When you look at after-tax yield was as high as 16%. As a result of that, the first major policy that we saw, one of the OMO auctions, that CBN excluded the banks from participating in that OMO auction. Weeks after that, we saw the circular around for borrowing clients, for clients that have borrowed from the bank, should not also be given access to treasury bills and OMO auction. Some weeks after that, we saw that total exclusion of individuals, corporates, which also involves the PFAs, from participating in OMO auction. And when you look at the dynamics or the structure of the fixed income market, OMO bills account for close to 70%, with about 14 trillion naira in terms of OMO bills. Out of that 14 trillion naira, 42% of that, which is held by foreign investors, about 32% held by the banks, and the remaining 25% being held by PFAs and fund managers. So when you quantify that amount, about 3 trillion naira, it means that as you have maturities, those funds, a major part of those funds, are unable to be reinvested into the standard OMO auction that we normally have. And based on the dynamics of demand and supply, there's been a shift in the demand. So the PFAs, which are the major investor within that space, have moved to the Nigerian Treasury bills, which is being issued by the DMO through the CBN. So as a result of that, the yield has dipped significantly.
So yes, that's just putting that chart
into
back
perspective,
to perspective, because if you look at where we're coming through from about 16% at this time last year, then we went down just around the election period. Then it looks like we're going to have a bit of an uptick. But again, that didn't happen. Of course, that's where the middle of the screen is. Then we have that major dip from June, right? Around June. Then there was that beep there, and it's all the way down till where we are at the moment. So this is a bit of the chart there, but let's talk about the primary market, which is, of course, where the central bank and the debt management office, and at the back end, the Ministry of Finance, by the way, the federal government, is actually teleguiding where they want the yield curve to go. What's the mindset of the government here in terms of what goes on into the primary auction calendars for both the central bank and the DMO?
Yes, interestingly, last year, based on the calendar that the DMO released, they planned only to roll over maturing bills. That means that, because typically what you have before is that you see, in terms of the DMO, raising additional funds apart from the maturities. If you look at the total sales in terms of NT bill, Nigerian Treasury bills this year, about 2.8 trillion, which is lower than what was sold, about 3.3 trillion naira last year. And you look at the OMO auction this year so far is about 14 trillion, close to 15 trillion this year, which is also lower compared to about 16 trillion naira worth of OMO auction that we saw last year. So we've seen that even for the government, they've tried to taper down in terms of the borrowings that they want to, especially short-term borrowings. It's bonds that we've seen significant jumps, over 200% this year, to about 576 billion in terms of long-term borrowings.
That's what the debt management did with the new 30-year bond, Naira bond.
Yes, there was a new 30-year.
Yes, the new 2049. 2049, the longest we have in the market. So if you look at that, therefore, the government is borrowing but try to rejig. So was that what was announced in 2017? Is this part of the playbook of what was announced late in 2017, that the government want to restructure these domestic borrowings?
Yes,
Is that what we're seeing play out right now?
In terms of the amount that is being offered, that's what we're seeing playing out. But in terms of the current yield environment,
yes,
this is like a deliberate policy from the CBN, trying to see how investors, as well as the banks, can begin to channel funds into the real sector. Though the real sector still has its perceived inherent risk, but rather than put your funds in a risk-free investment, in quotes, and earn 16%. When you look at, in terms of the margin on most businesses in Nigeria, when you look at, for most of them, maybe between 15-20% because of the high cost of doing business in Nigeria. So what would typically happen, so starting from when the CBN tried to persuade in terms of the policy on loan-to-deposit ratio in July, and moved that to about 60% and September to 65%, and we're expecting that there's an announcement that it may likely go as high as 70%. So now,
does that include the policy also on using the what you call the cash reserve ratio, which the central bank also announced, Gordon Emefiele announced, and says, well, this is an encouragement. If you lend to manufacturing, industrial, whatever, your CRR sitting with us will be used. You think all of this coupled together since June gives us a different scenario that we see if you put the table, if you put the chart back on screen to look at the different offerings that has been done and how the monetary policy have been trying to tweak, get not just the size of borrowings, but also the yield curve, as you said, trying to get push credit through the banks into the private sector.
Yes, the major target, which the CBN has made very clear, is they want the banks to channel more funds to the real sector as much as possible. Yes, we're all aware that in terms of the risk is really very high, but what we're also seeing now is more of repackaging existing loans. Yes, we can say loans, when you look at in terms of the statistics, lending has increased, but what is refinancing? The game out there now is banks are buying off existing loans at lower rates from other banks. And for any rational investor, they will be willing to go with the bank offering the lower rates. So we've not really seen in terms of creating new loans, new portfolios that will really impact as much as possible the real sector. And if we don't see that, what would only see it's more of repackaging. So for the complaints, yes, for them the cost of funds or their finance cost would go down as much as possible, and that would help them in terms of the margin for existing companies.
So
but we also need to focus on the informal sector.
So technically, the banks are deleveraging amongst themselves.
Yes, that's
creating the markets to deal. So that goes to the latest report we have in terms of non-performing loans and all of that.
Yes, that's in terms of non-performing loan, you would expect if the base has increased, and we don't expect that those loans that just this policy started in July, and you don't expect that those loans will become non-performing immediately. So it's not a surprise that in terms of the ratio of non-performing loan has gone down. The loan, which is the base, has increased. And the non-performing loan, we don't expect that to crystallize immediately. Before we can begin to know how effective this has been, and in terms of to rightly capture the non-performing loan, we need to also give some more time to see that for those, if there are new portfolios or loan portfolios that have been created, how have they been able to pay back after a certain period? It's based on that we can begin to gauge how effective in terms of the risk management policy of most of these banks.
Because I see in the newspapers almost on a daily basis, and some of the activities of some of the, let me use the word, the big banks, commercial banks, are beginning to show that they're putting out advertorials that appeal to folks in the creative sector, to those who are in fashion, in entertainment. They're asking them to step forward for loans, those who are in agriculture, agro-allied. So it begins to look like the banks are wooing those who are in the real sector And if you look at the GDP numbers printing in some of these sectors like music, entertainment, and what have you, it looks like the numbers are beginning to gradually on the rise, and manufacturing and industrial output going by the Q3 GDP numbers. So do you see that this monetary policy approach, what you call the unorthodox central bank policy, is beginning to knock at the door of the real sector, even though the door is not yet fully open, and there's an avalanche of loans going into the real sector? Is this yield curve environment, therefore, encouraging to the folks, the SMEs, the one-man business who are out there? Should they look at the current yield curve at the debt markets as an indicator of them to come out of their shells and say, look, we can approach the system? The MPR is still at 13.5, but we can approach the banks.
Yes, interestingly, the focus has changed, especially for the banks. There's been more attention to lending based on the current yield environment. Even for the investors, there's been more focus to what kind of structure can we come up with in terms of funding the real sector. Yes, that has really changed, which is one of the major objectives of the CBN's policy to encourage lending to the real sector. In terms of approaching most of the customers or businesses approaching the banks, there's a lot that still needs to be done in terms of the credit system that would give comfort. It needs to be standardized. We know we have the credit bureau system where you can do a credit check, but it needs to be standardized. There needs to be a scoring. There needs to be some form of incentive for those that have borrowed and have also paid back, so that everybody works towards getting a good score rating. And that would also change the dynamics in terms of how most people will approach lending or paying back their loans. So we feel that, yes, we're just starting, and if we see some form of more structured policy around the lending, then we may see like a boost. Yeah, you talked about the creative industry. Yeah, CBN have also set aside funds within that space to support that industry. So some of the banks would also be leveraging on that, because the CBN may not lend directly to the investors.
Yes.
Will lend through the banks.
Yes.
And for those banks, they had most of the advert that you touched on, and for most of the banks they are also trying to also play on that initiative that the CBN already put in place.
A quick one before we go on this break and we come back and flesh up this into the new year. Very quickly, and that is all already out on the social media, and you're part of this on Twitter. So folks are upset with the central bank right now that the new desegregation of NTB from open market operations is in favor of foreign portfolio investors and not local investors. How do you react?
Yes, in my view, I think the CBN's first focus is exchange rate stability. So they've looked at, in terms of how do we keep the foreign investors, and there will be no major shock on the external reserve. We can see that the external reserve have been depleting since in the past few months. Currently, it's about $39 billion from over $40 billion. How do we keep the foreign investors, and we still want to grow the economy? We can't continue to give bills to the local investors at 16% yield and expect them to lend. That's on one hand. And these foreign investors, we still need them in the short term, especially the foreign portfolio investors. Though we are not getting the foreign direct investment, we still need them. So what do we need to do to keep them? Though there are concerns around liquidity of the OMO bills, because if they hold about 48% of the 14 trillion OMO bills, how do they trade them? And CBN came out to assure them that they will provide competitive bid. So it's like CBN is trying to make markets for that space. Yes, the investors may not really be excited, may not really be happy about that, but we feel that there will be a lot of people who have to put on their thinking caps now to see how you want to structure funds, whether for projects, how you want to structure funds for SMEs that will give higher return than the current 4-5% yield. So it's easier for you to pitch an investment at 10%, based on, that's like 6% premium risk premium on a risk-free investment to support the real sector at this point in time than create an investment that may not yield more than 20% in terms of margin, may not give you more than 20% in terms of margin in an era when you have 16% risk-free investment.
Ayo, let's take a break. We'll be right back into Ayodeji, investment banker and CEO at Afrinvest Securities. Right after the break, the debt market in 2020. What's the outlook? What's the playbook? That's the conversation we're having next. We'll continue the conversation around Nigeria's debt market in 2019 and the outlook for the new year. But quick one, breaking news coming through. Andrew Bailey, the head of the UK's FCA, the Financial Conduct Authority, has been confirmed as the governor of the Bank of England. The central bank in the UK has a new governor. He will be coming in January when Mark Carney, the current governor of the central bank, leaves office. That's coming through right now to the newswire. The UK Central Bank has a new governor, Andrew Bailey. It's been confirmed now. He's been the favorite among other contenders. That's the story we're asking Julian Olayinka to talk to us about and a few others in a couple of minutes. But let's continue this conversation around what's the playbook for the Nigeria's debt market in 2020 with the yield curve that we're seeing right now heading towards zero level at the 9TB window. Ayodeji, that's where we're going. At the secondary market yesterday, and this is showing me just about this, I'm sure you saw this. This is 4.5% on NTB maturing 12th November 2020. This is about a 1 year treasury bills yielding 4.5%, not at the primary market, but at the secondary window on FMDQ. This is the new low. This is the new normal, isn't it?
Yes, that's the new normal, and investors have to come up with that reality. When you look at it, the concern is that when inflation rate is around 11.8%, as at November, you look at in terms of the negative return. So it means that if you are investing at 4% and inflation is at 11%, the return that you get on such investments is really negative, because after a year you may not be able to purchase those items that you would have purchased now as a result of the price increase. But what I think that for investors, what we need to do is, one, we need to first come to terms that this is the new normal for now. It's also, business is a cycle, and we don't expect that this should last for a very long time. We'll see that because there's a concern around the liquidity around OMO bills. If most of the foreign investors begin to take out their funds, we may see that the CBN may have to review this policy, because the bank is not, bank alone cannot provide the liquidity to absorb the OMO auction from the foreign investors. So that's a concern on one hand. Which is one point I'm asking. Who's buying? Where is this massive primary market auction bidding coming from? Local institutional investors, local retail investors, or foreign FPIs? The PFAs. You know, the PFAs, the accounts, they have close to 20% of OMO bills. And you look at that on their books. On their books. So upon maturity, when you have currently, if we estimate that maybe about 2.5 trillion. So when you look at in terms of maturities, these funds, and for the PFAs, they are not willing to take risk in terms of the equities market. So they have limited options. So they're holding. They're willing. They are caught in between. For deposit, the banks are not willing to take deposits so that they are not forced to create loans. You know, there's a policy around loan to deposit ratio. So the more deposit you have, the more headache around creating loans. So the interest within that environment too has dipped significantly in terms of placement, or what you call deposits. Is that how the new game in town? So when you look at for the treasury bills, which is what you call the short-term instruments, yes, that has also declined. But they will prefer to still invest at 2% rather than leave this fund at 0%. So for PFAs, yes, the yield is much lower, sharply lower than what they used to have, but they can live with that because they hold in pensions that is not maturing in the next 360 days. But you also look at the impact. That means they are holding our pensions. So what are the funds that should be handing 12, 13%, or that have been earning, let me put it this way, that way, that have been earning 12, 13% return. On every 10 million naira, you earn like 2 million, 3 million. Now you have to earn something very little. It means that the cumulative return that you will get, that would get upon retirement, is also being impacted. It's also
so if we check the PFAs, if we check the PFAs book for 2019, this is going to reflect on their books.
Yes, it may not have as much, because that just started in terms of when you look at the overall return.
So 2020 will be
much impact. Yes, 2020 would be lower. You also want to look at, we shouldn't also forget the fund managers. When you look at the asset under management, which is about 750 billion, and for over 70% of that are money market investments. For them, yes, the return may still look high now, but over time, when they get new funds and when there are maturities, those returns too will also be adjusted to what we currently have in the market in terms of the net asset value of their investment.
Shola Agundi is watching the show and he's asking questions. I think he's getting a little bit upset. He's going to ask, for how long would we continue to treat foreign portfolio investors as new brides? For how long would the negative real yield subside? What would be the fate of insurance companies that sell life annuity products in this negative yield environment? Shola Agundi, thank you very much. He's on Twitter handle OBZZZY. Okay.
So I think
that's a question too. What happens to insurance?
These are very interesting times that we all need to sit down and see how we want to come up with structured products. You'll notice that we hardly have project-based bond. We don't have structured products. We saw that during the agri sector. We saw like the funding coming up with funds to finance
a bit of agriculture,
within that short period. But we also need to come up with project-based funds. We know we have the NDI have the Nigerian Debt Infrastructure Fund.
Yes,
but
the idea. So should Lagos State, for example, just put the 4th Mainland Bridge and put that as an infrastructure bond and just roll it out?
Yes,
would that be an idea?
It's not impossible. You know, also the government is looking at raising about 10 trillion naira infrastructure fund. If that's next year, if that's eventually scaled through, that would also reduce the pressure in terms of liquidity in the market, in terms of the yield environment, because currently you have high liquidity chasing just very few instruments, and that will reduce liquidity. But that would also help. But the challenge we have is most of these projects are really not bankable in terms of the structure. They need to, in terms of the PPP arrangement, the consensual arrangements, needs to be very watertight, such that it provides confidence for those that will lend. The pension guys should be, one of the ideas, I suppose, for setting up the pension fund then was to see how they can also support the economy. And that was why they were excluded from investing in Eurobond or foreign denominated assets.
Yes, so under the new budget calendar of 10.6 trillion for 2020, how do you think the new borrowing environment, the new appropriations will impact the new yield curve that we have on the market? You have an idea what the calendar will be for both the central bank and the DMO for 2020?
No, I think that they will sustain the current rate in terms of the offers. And for the DMOs, for them, in terms of the cost of financing has reduced significantly, so they will receive that with great news, and I don't see them increasing the amounts offered. They are also looking at raising Euro bonds and also the Jollof bond in terms of raising fund abroad, but would be denominated in Naira. That would also help a lot as much as possible. So, but what I think investors or the fund managers should begin to do is to come up with structured funds and see how they can get with a rate that is around 5%. It means if you come up with a fund to support the real sector in terms of projects, in terms of industry, then you would be able to sell your products as much as possible. Yes, it comes with its risk, but there's also some form of, by the time you also do some credit enhancements to also help to reduce that risk to a large extent as much as possible, then that will also create some form of comfort. So for the insurance companies that have their annuity and they've already locked in for a certain period, yes, we need to, as you try to solve one problem, sometimes another problem is created, but you want to look at it holistically in terms of what will be the major impact if we all begin to look at, I can't stay with 2%, can I take more risk and invest in the equities market? And yield is currently around 12-13%. Dividend yield in the equities market around 12-13%, though it has its own risk. Can I look at that? Even for blue chip companies, commercial paper, they can also come up with commercial paper at single digits. That was one of the aim of the CBN.
Original intent.
Intent of the CBN,
yes.
To use CRR of banks to fund commercial papers.
So,
but now, most of them can come up with
so
for industries,
for companies on the stock exchange or not listed on the stock exchange, do you think the new yield curve environment or pricing of these assets has something good in it for them?
No, I think it's positive for them in terms of finance costs.
So not just looking at the headline interest rate of 13.5%, but look at the secondary market and the primary market offering.
The MPR has become ineffective, so there are other policies that CBN has been using to guide rates. That's just like, it's no longer like a reference rate for interest rate. So looking at the current interest rate environment at 4-5%, so for companies, blue chip companies, by the time you had 1 or 2% premium, it means you can raise short-term funds at 6-7%. I think Flour Mills came out, I think about 2 weeks ago, about 9% for 270-day paper. So for them, if your cost of your finance costs or interest expense is around 21% in maybe in the last 2-3 years, and you're able to raise funds at 9%,
I'm saying this,
that's enough savings.
I just want you to talk through, we have a few seconds to talk through the last chart that you have here, trying to look at our 3 months to our 20-year papers and see what the yield curve look like. If that can just come up very quickly and get Ayo to talk to that. We're coming from about 14.3%. We're looking at 11.7% for a 20-year paper. Yes.
Interesting, we've seen that dropped, based on this chart, it showed a quarterly yield curve. And you can see from Q1, there have been consistent drop from Q1 to Q2. And currently in Q4, it's dropped to an average of about 5%. That's for the short-term investment. But you also look at the long-term dated instruments, still currently around 12%. So investors should also begin to shift in terms of looking at short-term investment to long-term investment. Yield around the FDM bonds market is still between 9 to 12%. So you can still take advantage of the 2 to 3 year time to maturity FDM bonds rather than invest at 5% for the 1 year.
Isn't that what the government wants to do? Get everybody to go long-term. Wasn't that the advice of the World Bank, IMF, everybody? Push out this investment into long-term and stop getting hot money around here. But that's a conversation for another day. Ayodeji, thank you so much. We appreciate that. Ayodeji from Afrinvest Securities, the CEO.